Good evening. Welcome to the Money Show, the only daily show of its kind which brings you all the market's top financial experts to answer all of your financial queries. I'm Avni Raja, with me Avan Dubash. Hi Avan, lots lined up for today, but first the headlines.
Absolutely, we've got a jam-packed show. We'll be talking about bitcoins as well as mutual fund investments, but in the meantime, here are your top stories. The RBI stuck to the script as expected, left the key policy rates unchanged, even as it cited upside risk to inflation, hiking the inflation forecast to 4.3 to 4.7%. They also say that the economy will grow at 7.8% in the fourth quarter.
And there's no stopping Bitcoin mania as the cryptocurrency tops $12,000 for the first time ever. Bitcoin's eye-popping rally forces JP Morgan to do a U-turn. The global brokerage now refers to the controversial cryptocurrency as the new gold.
And it's the markets which didn't see any rebound. The Nifty sub 10,050. It was a volatile day after the policy outcome, with the PSU banks worst hit as the governor of the RBI, Urjit Patel, mentioned the fine print of the bank recapitalization plan. Those are your top stories at this hour. Let's bring on board our guests who will be joining in today. Harsh Rungta, personal finance expert, is with us on the show. And to talk about the meteoric rise in Bitcoin, Sandeep Goenka, he's the co-founder and COO at ZepPay. And I'm just going to come to you in a bit from now, but I want to just talk a little bit about this crazy rally, really, because that's the only way to describe it in Bitcoin. You know, it surged to $12,000 for the first time, and that digital currency has taken just 6 days to hit this mark, from $11,000 to $12,000. And all of this comes at a time when there's lots of questions about the real value, the worries about whether or not there's a dangerous bubble floating around. So before I'm going to come to you, I'm going to go across to my colleague Mubina, who talks a little bit more about this. Mubina.
Well, here's something that our viewers can chew on. If you had invested 1 lakh rupees in Bitcoin in 2010, you would be sitting on a whopping 700 crore rupees right now. That's the kind of rally that Bitcoin has delivered. Whether it's equities, whether it's commodities, whether it's currencies, Bitcoin is now the new asset class in town, and the rally is something that has boggled even the brightest of brains that are there in the market. If you'll just look at the way Bitcoin has rallied in the year of 2017, the move from $1,000 to $2,000 has taken 138 days. But as the Bitcoin has continued its progress towards the 5-digit mark, you can see that every $1,000 rise has taken lesser and lesser number of days. And in fact, from $10,000 to $11,000, the Bitcoin took only 12 hours. That's the kind of frenzy that you are seeing beyond, behind this most popular cryptocurrency. Now, there are the bulls and then there are the naysayers. And unfortunately, the naysayers, of course, are higher in tally. We have a series of countries like China, like Vietnam, which have warned and banned cryptocurrency exchanges. But in fact, there's also the RBI, which has warned against trading on the Bitcoin. But then there are, of course, the bulls. Like, we have a series of exchanges that are launching the Bitcoin futures. Like, for example, the CBOE is going to be launching a future option, a future product on the Bitcoin on the 18th of December. There is also, of course, or rather the 10th of December, there's also the CME, which is launching a product on the 18th of December. But I guess the clear winners over here are the Winklevoss twins, the original brains behind Facebook, who used the Facebook payout and invested it in Bitcoin and now have become the biggest billionaires of Bitcoin.
All right, thanks Mubina for that. That of course was a quick wrap as far as what we've been seeing on the Bitcoin. But I'm going to go across now to Sandeep Goenka, who's with us. Sandeep, if you can take us through first as to what's the kind of traction that you've seen, especially over the last few months with respect to Bitcoin. Because on the Money Show here, we've been getting a lot of investors, a lot of people who are interested in buying the Bitcoin, asking questions. What's the kind of increase in the kind of traction that you've seen?
So, of course, there is always a surge in the number of users whenever the price rallies like the way it has. But this is not the first time that the price is rallying. It has happened many, many times in the past. Since the 4 years of ZepPay's history, this is maybe the 5th cycle. Of course, the current cycle is always bigger than the previous one. Currently at ZepPay, we are adding about 500,000, that's 500,000 users every month. These numbers typically double every quarter. So since we've started ZepPay, these numbers have been increasing.
Second, I want to just get those numbers straight, Sandeep. You said 500,000 users every month. That means these are the number of people who are logging on to your portal to invest in Bitcoins?
That's true. That's correct.
Okay. That's really as crazy as probably the valuation that the Bitcoin is now commanding. But, at a time like this, one really needs to be careful, because the Reserve Bank has come out very categorically and said that they are warning of risk. They're saying that this is a virtual currency and one can't really look to put money into this, and they are warning of some severe risk. How would you like to respond to that? Because I'm sure, call it a case of just, fear of missing out, that the kind of interest that the Bitcoin saw when it was at levels of $2,000 or $2,500 was not half as much as what it is now when it's quoting levels of 12,000. With these RBI warnings, how would you like to respond to this, or advise those who are looking at Bitcoins as a possible investment opportunity?
So we totally agree with the RBI in its warning. This is actually the third warning. Every time there is a price rally and a lot of new users kind of enter the ecosystem, RBI issues a warning circular. And I think they're right to do that. I think if people, invest their money without understanding in something, and if they lose, if something goes bad, and then they blame, the government or the regulator, I think that's not fair, right? If they make money, then they don't, of course, give them the credit. But if they lose money, then they run to the RBI. And I think so. What RBI is trying to say very correctly, I think, is that, hey, look, this is a new technology. If you do not understand it, it carries legal risks, it carries market risks, it carries technological risks. And I totally sympathize with this kind of a warning to the general public. I in fact, appreciate and agree, investing in Bitcoins or cryptocurrencies is no different than investing in anything else. It should be backed by knowledge. Just because the price of a certain commodity or an asset or a cryptocurrency is going up, that does not make it a good investment. Investment backed by knowledge is something that Zeppe always preaches, and I really I'm trying to use your platform and tell your users that invest in knowledge first. Once you convince yourself that this is a revolutionary technology, then make an investment in it.
Reiterating in some sense what the RBI is saying, and something that our viewers as well should take note of, that always do your homework and research, and not just invest in something like Bitcoin. As RBI said, they do not legally back Bitcoin. But Sandeep, just coming back to you, in terms of the future of Bitcoins, cryptocurrencies on a more larger scale, how do you see that panning going forward now?
The future, today, of course, there's a lot of hype around Bitcoins, and it's become, everybody's covering it. But when we started the company 3-4 years back, we gave up substantial businesses to do that, because we believed in its future. We believe that Bitcoin is a fundamental infrastructure technology, just like the way the internet is, and it's going to be bigger, if not as big as the internet in the coming future. Bitcoin has some great advantages, especially for an emerging economy like India. Some immediate results are that we can save billions of dollars in remittance. Philippines, the second largest remittance market, has allowed remittance companies to accept Bitcoins. We can directly save about $7 billion. It can assist in the Prime Minister's dream of financial inclusion. So right now the narrative is on the risks. We are trying to turn the narrative around to the opportunities that India has if we adopt this technology. With this technology, India is already a technology hub. With this technology, India has the potential to become a fintech hub in the near future.
On that very optimistic note, Sandeep, I would like to take time out to thank you, for giving us clarity on these RBI warnings and what really the future of Bitcoin is. So clearly talking about how this is just the start and it's going to be an absolute revolution. Do remember, though, that we are not in any way advocating investing in Bitcoins. We're only talking about the trends that we've seen so far, the kind of interest that one has witnessed, and what countries across the globe are saying. The RBI, though, still warning against the risk of this virtual currency. Sandeep, thank you so much for taking time out and joining in with that perspective. In fact, I want to bring on board my other guest, who is Harsh Rungta, personal finance expert. And Harsh, we discussed this time and again, and I can't help but bring up the topic of Bitcoins yet again, given the fact that there's an eye-popping rally. You just heard out Sandeep, who is of Zeppe, talking about how this is just the beginning. This is going to be a revolution, really. What is your advice, and how investors should really look at this? You're still warning and, cautioning against Bitcoins?
Oh, absolutely. I think Bitcoins as an investment, absolutely, I would caution against. Bitcoins as something which is, say, part of your mad money, some part of your portfolio that you want to do speculation with, or that you want to take big risks with. And for that, you need a pretty large portfolio to have an allocation to a risky part of your portfolio. Then you can probably do it, but stay away. I mean, uh, one, I completely agree with Sandeep when he mentioned that you better understand before investing. And I think very, very few people claim to understand, do actually understand Bitcoin. I definitely, I don't count myself among one of them. This stampede literally for this, and it has happened now a couple of times. I mean, it reminds you of all the old adages, right? I mean, we had this for real estate that buy land, they stopped making it, right? But the technology comes along, FSI gets increased, that's effectively making land. I mean, similarly, this is the price of Bitcoin to a great extent is being driven up, apart from the frenzy, is being driven up because of the perceived shortage, because only a certain number of Bitcoins will ever be mined. But I think, and this is a technology-based product, and a completely different technology could tomorrow come along and replace that. So again, as I'm saying, let me add to all the warnings that are there. As an investment, stay away. Be fearful when everybody else is greedy. I think let's just remember that uh, what the master has said.
Absolutely, Harsh. A word of caution there coming in from Harsh Rungta as far as the Bitcoin is concerned. Make sure you've done your research before venturing into Bitcoins or any other cryptocurrency. But on that note, let's slip into a quick break. We'll come back and take up some of your personal finance queries on The Money Show. Welcome back. You're watching The Money Show, and we have with us Harsh Rungta to answer all of your personal finance queries. Harsh, let's get to our first query for today, which is Jay Prakash, who sent us a question on Twitter saying that which is the best in mutual fund, best fund within the mutual fund space to invest in for exposure to the pharma sector via an SIP or a lump sum. Please advise. Harsh, your advice to him, essentially, he's talking about sectoral funds, which you're usually quite against.
Yes, I think we have answered similar questions in the past, and I think when you go for a diversified fund, you would get certain pharma exposure. The Nifty 50 itself has about 4% exposure to the pharma sector, and depending on which mutual fund you choose, you would get more or less exposure than that. If at all you have some expertise in the pharma sector, then I would suggest instead of buying a pharma sector fund, you shouldn't get into sectoral exposure without a special expertise. If you have a special expertise, then I would suggest that you should actually look at the direct equities in those sectors, because you would have the expertise to select that rather than selecting a pharma sector fund. That is my advice. That has been my advice in the past, and I think that continues to remain. I think Jayprakash also asked whether you should do it via SIP or a lump sum. I think clearly any equity investment, even though it may be in a sector that has done well or it has not done so well. I think equity investments typically should never be in a lump sum. You should always build it up systematically. If you have a lump sum to invest, put it into a debt fund and sort of transfer it over time into equity. That applies to regular equity, it applies to sectoral fund if at all you want to invest. The only time you could probably do a lump sum is if you're taking it out of one equity source and putting it in another equity source. So in that case, a lump sum is fine. I think otherwise, it never should be a lump sum.
Okay, I hope you've taken note of that advice. Diversified funds will give you good exposure to the pharmaceutical sector. If you have enough knowledge, you can even look to invest in equities, but SIP is the best and the safest form of investment. Investing in a lump sum, that's not really advisable. Well, next up, Harsh, we have a query coming in from Ranga. He says, can I have one liquid fund portfolio and keep adding funds as in when I get extra money? His second question is it possible to have flexible STP amount to other small cap funds? What would you advise? And he says, I'm adding money to a liquid fund every month. And what exactly would you advise?
I think from the tenor of his question, not very clear what Mr. Ranga Shanks wants to do. But I think what he really wants to do that put money in a liquid fund, whatever interest or growth it generates, he wants to use that to transfer that to equity. And he is asking whether he can do this in tranches. So one, I think that he could definitely do is that most of the fund houses have these specialized systematic transfer plans. For example, the one that I remember offhand is in Reliance Mutual Fund, you have something called a capital appreciation STP facility. Other fund houses have similar facilities. The name might be different. In which case, all that happens is you put in the money. Whatever is the growth, you can pre-decide which fund it will go to at the end of a predefined period. So you can provide that at the end of every month, whatever is the growth that gets redeemed from the liquid fund, and it will go, say, into small cap fund. And can he keep adding to those funds? Of course, he can keep adding to those funds, and only the growth portion will go into a small cap fund. I think this is a conservative strategy. It's a good strategy. He wants to keep his principle intact. Whatever growth he gets, he wants to shift it to equity fund. It's pretty conservative, but definitely it's very doable. It's doable easily. The other way to do it, of course, is that he can use a regular STP facility by which he pre-assumes a certain growth and shifts that much to the equity fund. The actual growth may be more or less, in which case there would be a adjustment he might have to do at some point of time.
All right, Ranga, that's as far as how to manage your liquid fund portfolio is concerned. Conservative, but a good strategy, says Harsh. Harsh, now, the other question really that's important in terms of how to select funds, because sometimes we find that there is either too much of focus or maybe not enough focus. But once somebody has decided which category they want to invest in, for example, whether it's a diversified fund or a mid-cap fund, how do you go about zeroing in and narrowing down on where you want to put your money and which fund? Because some of them, they're also similar in terms of their underlying assets that they have.
Yeah, so I think the bigger decision always is to decide which kind of asset you want to invest in, equity, debt, gold. I think various studies show that, the final determinant on return, the asset allocation plays a much larger role than the actual selection of security within each of these categories. So, say having decided equity and within equity having decided diversified or having decided large cap or small cap, how do you go about choosing a fund? And again, we see clients really, today there are multiple places from where you can find out which are the, say, large cap funds that are doing well, and you can invest in one of them. Again, we see clients who will go out and spread their money over 3 large cap funds. That makes no sense because there would be so much overlap among them that eventually you will end up getting an index return.
something similar people do. They just pick up all the highly rated diversified or multi-cap funds, or they will pick up the highly rated mid-cap funds. Eventually, over-diversification is as bad as under-diversification, and trying to pick winners of every year again is a mistake, because people shift their funds year after year. Again, various studies show that as long as the fund that you have chosen is among the top 2 quartiles, and if you have stuck to it for the long period, you eventually end up getting a much better return than if you were to keep shifting it year to year. Winner every year will change, but you don't really, again, I think this is something we have said in the past. The attempt to maximize your return actually leads to decay in your return. I think the effort should be to optimize the return rather than trying to maximize it.
Point note taken. Thanks very much, Harsh, for giving us that discussion pointer on, really how much is focused on fund selection, maybe a bit much at times. I hope we've cleared all of your doubts and queries. We spoke about the Bitcoin extensively as well. On that note, we wrap it up right here on the show. Thanks so much for watching. Keep those questions and queries coming in.